Welcome to the Northbound Wealth Podcast. All opinions expressed by Brent, his co-host, or his guests are solely his own opinions and do not reflect the opinions of Northbound Wealth Management LLC. This podcast is for informational and educational purposes only and is not intended as personalized recommendations or fiduciary advice. It is not intended to provide and should not be relied upon for any investment, accounting, legal, or tax advice, or as a solicitation to offer or to buy any securities. Clients of Northbound Wealth Management LLC may maintain positions in the securities discussed in this podcast.
Hello, everybody. This is Brent Foster. This is the 108th episode of the Northbound Wealth Podcast, weekly market insights. Today is May 26th. Happy Memorial Day. I came into the office just to get some things done over the long weekend before the start of the week officially. So here we go. Stocks moved lower last week as fiscal fears and fresh tariff threats loomed over market sentiment. The S&P 500 index fell 2.61%, closing at 5,802 and change. The measure is still in positive territory for May with a month-to-date gain of 4.2%, but it is now down 1.3% for 2025, so on the year. While the NASDAQ Composite Index dropped 2.47%, closing at 18,737 and change, the Dow Jones Industrial Average slid 2.47%, closing at 41,603 and change. The MSCI EFA Index, which tracks developed overseas stock markets, advanced 1.14%. So, unexpected tariff news. The rally or relief rally last week had put the S&P 500 in the black for the year for the first time in months. The year-to-date gain was short-lived as worries about tariff impacts sent the index back into the red. President Donald Trump threatened to place a 50% tariff rate on goods from the European Union and said Apple might have to pay a tariff at least 25% for iPhones manufactured abroad. All of the S&P 500 sectors fell on a weekly basis. The energy sector had the largest percentage drop, sliding 4.4%, followed by a 3.5% decline in technology, a 3.3% drop in real estate, and losses of 3.1% in each of the consumer discretionary and financial stocks. The smallest decline was logged by consumer staples, which edged down 0.4%. Obviously, it was defensive last week, as you can tell. Phillips 66 was among the energy sector's hardest hit stocks, falling 10% as the oil refiners' shareholders voted for two Elliott Investment Management nominees to the company's board based on preliminary results. A Reuters report also said that Phillips 66 will start laying off most employees at its Los Angeles facility in December. The company previously said it would begin shutting down the plant in October, with job cuts to follow 2 months later. Shares of solar companies weighed on the technology sector as U.S. House Republicans passed a bill that eliminates important clean energy credits, according to media reports. Among the decliners, shares of Enphase Energy fell 21% and First Solar lost 11%. In real estate, decliners included shares of Weyerhaeuser, which fell 5.6% as the company said it agreed to purchase nearly 117,000 acres of timberlands in North Carolina and Virginia from Roanoke Timberlands for $375 million. Weyerhaeuser also unveiled plans this week to sell its Princeton, British Columbia lumber mill to the Gorman Group for approximately 120 million Canadian dollars. That's $86.6 million in US in cash. US stock market will be closed on Monday for Memorial Day, so it's going to be a shortened week this upcoming week. Economic data expected the rest of the week includes April consumer spending and personal consumption expenditures, or the PCE number, May consumer confidence, consumer sentiment, and the first revision to Q1 gross domestic product, among other reports that we'll be following here at Northbound Wealth Management. Thank you, Y-Charts, for the weekly market insight numbers, major index return summary. So the NASDAQ year-to-date is down 2.70%, but on the one-year trailing is up 12.74%. S&P is negative 0.82 on the year, but up 11.64 over the last year trailing. MSCI EFA Index, which tracks developed overseas stock markets, is up year-to-date 16.26%. quite the significant outperformer over US this year. First time in decades that's actually happened. 1 year trailing for international is up 12.60%. Dow Jones Industrial Average is negative 1.56 on the year. And then 1 year trailing is up 8.39%. So there you have it. S&P 500, you know what, is still a bellwether, in my opinion, in the global economy. The U.S. Dominates in many areas. Okay, 10-year Treasury rate, 4.51. That's up about 2.5% over the last month change. It was 1 month ago about 4.4, 3 months ago about 4.4, and about 1 year ago about 4.47. So we're slightly up over the past year for the 10-year Treasury at 4.5 to 4.51%. We're going to be keeping track of that as we go. All right. Thank you, YCharts, for that. This week, key economic data. You heard quite a bit of it. There's a bunch of Fed heads talking Tuesday and Wednesday. I'm not going to go through all of them. Going to be looking at gross domestic product on Thursday, jobless claims. We always like to look at just to see how the economy is coming in, reporting. Some of these are at lagging indicators, and that's okay. At least we have something to measure. All right. Notable companies reporting earnings this upcoming week. NVIDIA, that's the big one, on Wednesday. So we'll be paying attention to that. Salesforce is also reporting on Wednesday. Thursday, Costco, which I like to track. It's just kicking butt, taking names. And then Dell Technologies, we'll see what they have to say. Tax tip of the week. Help get your federal withholding correct with this tool from the IRS. So if you're trying to figure that out on tax withholdings, here's a good tool to check out. The IRS has a handy tool called the IRS Tax Withholding Estimator to help taxpayers better understand their withholding. It's essential to examine your federal withholding periodically to ensure you're comfortable with the amount of tax withheld. Checking your withholding status may be a good idea to consider if you have experienced a change that may affect your tax status, such as going through a marriage or divorce, having or adopting a child, purchasing a new home, working 2 or more jobs at the same time, only working part of the year, claiming credits such as the child tax credit. This information is not a substitute for individualized tax advice. Please discuss your specific tax issues with a qualified tax professional, and this tip was adapted from irs.gov. All right, so go check that out. If you have any questions, stay tuned for the next segment. We got a good show for you. Thanks. In this week's Technical Analysis Spotlight, I came across an article that was written on May 23rd, and it's written by David Keller. He's the president and chief strategist of Sierra Alpha Research, and I want to give a shout out to David. I think this is a really good analysis. Also, a great article just explaining some technical stuff that might be, I think, communicated in such a way that people can understand it. So let's dive in. The headline of the article is called "What Happens When the S&P 500 Breaks Below Gap Support." So key takeaways from this article as a summary before we dive into the details. The gap and run scenario suggests an influx buyers driven by investor optimism. An exhaustion of buyers will create a gap and fail pattern where an upside gap is followed by sudden selling pressure. And then unless the S&P 500 can hold its recent price gap and remain above its 200-day moving average, the gap and fail pattern would be confirmed. I happen to agree with this. So I'm going to be watching that closely, the price action of the S&P and all the other indicators that go along into figuring this out. But let's continue with his article. My main question into this weekend was, quote, will the S&P 500 finish the week above its 200-day moving average? And as you know, that particular moving average, simple moving average, from a simple charting technique and practice is something I've talked about on the podcast quite a bit over the years. All right, so let's keep going. And while the S&P 500 did indeed finish the week above this long-term trend barometer, our main equity benchmark is now within the gap range from earlier this month. We'll get to that crucial S&P 5 chart a little later, but first I'd like to explain why gaps matter, why the price action post gap is so important, and then apply these lessons to the SPX. For those of you that don't know, it's the S&P 500. So there is a saying out there on Wall Street and in charting world and technician world, that is gaps get filled. So we got to pay attention to that. The gap and run scenario suggests an influx of buyers. So let's cover that one. One of two things tends to happen after a gap higher, which is what's happened. We've had a relief rally. The S&P 500 has gone up from the lows from trade war and tariffs. It's really gapped higher. I've talked about that recently. And so he continues on and says a gap higher within an uptrend phase. The first scenario, which I call a gap and run pattern, is when additional buyers come in to push price even higher. And he's got a chart of that, that particular of Microsoft actually. And Microsoft, if you pull that up and look back over the past year or so and have maybe the 200-day moving average, the 50-day moving average and price and volume and the RSI, you'll be able to see it. Let's see. Microsoft features this gap and run pattern with the gap higher on their Q1 earnings report, followed by an additional appreciation in price. Basically, investors are not afraid to accumulate more Microsoft in their portfolios even after the stock gapped up from $395 to $430 overnight. So, shares of Howmet Aerospace, ticker symbol W or HWM, demonstrated a similar gap and run pattern recently, although this example is perhaps even more significant because the gap took the price to a new all-time high. Again, we can see that additional buyers are coming in and accumulating more HWM, fueling their gains after the gap. Now, let's talk about the gap and fail. So the gap and fail pattern shows a lack of willing buyers. So the opposite of the gap and run. Sometimes a chart will show a very different path after the gap, forming what I've termed a gap and fail pattern. Unlike the previous examples, here you'll see a lack of willing buyers causing the stock to quickly reverse lower into the range of the price gap. So it's kind of like filling the gap, but to the downside. Okay. In the case of semiconductor producer Monolithic Power Systems, ticker symbol MPWR, the gap higher earlier this month was followed by two additional up days, which propelled the stock above its 200-day moving average. This short-term pop higher was followed by a sudden downside reversal, representing an exhaustion of buyers after the upside gap. So that's not good. That's kind of hard if you're a trader. Okay. Now, if you're a long-term investor, you may not care so much. First Solar is demonstrating a similar pattern to MPWR with a gap higher, which pushed the stock just above the 200-day moving average to test a 38.2% Fibonacci retracement level. A couple days later, First Solar was back below the 200-day moving average, followed by further deterioration that eventually closed the gap from earlier in May. All right, so pay attention to that. The S&P 500 could test its own gap support. So what do those example charts have to do with the S&P 500? Well, the S&P 500, the SPX, that's the ticker symbol, traded higher for about a week after the upside gap in early May. We've drawn a green shaded range to highlight the gap from around 5,725 to 5,780. This gap includes the 200-day moving average and also lines up with the late March swing high. I see the S&P 500 as in a constructive pattern as long as it remains above this price gap range. If we can see an upswing after this week's pullback, then this could be just a pause within a broader recovery phase for the S&P 500. On the other hand, if we see any further price weakness from the major benchmarks next week, which is, by the way, this week, then the chart of the S&P 500 will start to look pretty similar to the other gap and fail charts that confirm a lack of willing buyers. If we do see that downside follow through next week, we'd expect further deterioration to the 5,500 level of the S&P 500, representing a 50% retracement of the February to April sell-off phase. So, David Keller, thank you for that analysis. Sierra Alpha Research, he's the president and chief strategist. Also, he does a lot of work with stockcharts.com, and so do I. I have I work on a lot of my annotations there. So, thank you, David, and also want to give a shout out to you. I like what you're putting together there here at Northbound Wealth Management, and stay tuned for the next segment. What do a lot of people overlook when they inherit IRAs? Most people think of an inherited IRA as simply another account to manage, but it can be easy to make costly mistakes. Here's what many people don't understand when inheriting IRAs. The 10-year rule. Typically, you must withdraw all of your funds within 10 years, but some exceptions apply. Lump sum trap. Taking everything at once can push you into a higher tax bracket, which might leave you with far less than you expected. Investment risks. The original owner's investments may not align with your financial goals. It's not just dad's IRA. Reallocating may be a good idea to consider. Remember that tax rules are constantly changing, and there are a wide range of exceptions that can apply. There is no guarantee that the tax treatment of Roth and traditional IRAs will remain what it is now. If you have inherited or expect to inherit a traditional or Roth IRA, be sure to consult a financial professional for guidance. Did any of these come as a surprise to you? Drop your thoughts at northboundwealth.com. Contact us. All right, on to the next segment. So, inflation-adjusted tax brackets for 2025. So, preparing your taxes for next year. Is that what you guys are doing? You're already planning for 2025 taxes. So, married filing jointly, income tax brackets are 24% tax rate is an income range of $206,000 and change to $394,000. I'm rounding just because of ease on this podcast. 32% tax bracket is $394,000 to $501,000 in income. 35% tax bracket is $501,000 to $751,000. And then 751,000 plus. So if you make over that, you're in the 37% tax rate or bracket. Capital gains and dividends in 2025 for long-term investments in qualified dividends, 0% rate up to $96,700, 15% rate from $96,701 to $600,000 and change. 20% tax rate on anything over $600,000, $51. That's for capital gains and dividends for 2025. The kiddie tax update. So parents with children under 18 or under 24 if full-time students who are dependents. Okay, so that's if they're dependents. Your child's unearned income, typically from investments above $2,700 for 2025, will be taxed at your marginal tax rate. This is up from $2,600 in 2024. Important notes: couples with modified adjusted gross income above $250,000 may still face the 3.8% net investment income surtax. The Social Security tax wage cap increases to $176,100 for 2025. Mark your calendars for quarterly tax payments: April 15th, June 16th, September 15th, and January 15th, 2026. I certainly have. Got to pay those estimateds. This segment's for informational purposes only. Is not to be a replacement for real life advice. We would encourage you to speak with your tax, legal, and accounting professionals before modifying your tax strategy based on this information you just heard. I've got out there on my LinkedIn, I've got a nice little chart of this stuff. So if you want to go look at that, you can see a picture, and it's worth 1,000 words. All right. Hello, everybody. I want to leave you with some final thoughts. Through ups, downs, and headlines, what still works in the markets? Markets test our patience. Whether due to political noise, economic shifts, or sudden volatility, it's easy to wonder, is now the time to rethink my strategy? As your financial professional, part of my job is to monitor market movements economic data, and shifting conditions, so you don't have to. My focus is on positioning your portfolio for today and the long term. One of my favorite reminders comes from the legendary investor Sir John Templeton, who said, "The four most dangerous words in investing are, 'This time is different.'" History shows that while no two market environments are identical, disciplined investors who focus on fundamentals, not headlines, are often rewarded. Emotions can work against us. Many of the market's best days occur during periods of uncertainty or immediately following a downturn. Trying to time the perfect entry or exit can be costly. Missing just a handful of those key days can significantly reduce long-term returns. The markets have delivered over time. Since 1957, the S&P 500 has returned an average of 10.5% annually despite recessions, inflation spikes, geopolitical events, and leadership changes. Remember, index performance isn't indicative of past performance of a particular investment. Past performance does not guarantee future results. However, this long-term perspective is crucial. A steady, diversified approach still works. Strategies like dollar cost averaging and diversification are designed to help manage risks and emotions. They may not be flashy, but they're time-tested. We hope this message serves as a reminder that our role is to be in your corner, offering guidance, clarity, and insight amid uncertainty. We're here for you. If you have any questions or concerns, please contact us. Reach out to Northbound Wealth Management. Our priority is to help you remain confident in your long-term investment strategy. And keep in mind, diversification is an approach to help manage but not eliminate investment risk in the event that security prices decline. And dollar cost averaging does not protect against a loss in a declining market or guarantee a profit in a rising market. Specifically, dollar cost averaging is the process of investing a fixed amount of money in an investment vehicle at regular intervals, usually monthly for an extended period of time, regardless of price. Investors should evaluate their financial ability to continue making purchases through periods of declining and rising prices. And the returns and principal values of stock prices will fluctuate as market conditions change. Shares, when sold, may be worth more or less than their original cost. So thank you for listening to the Northbound Wealth Podcast. I hope you guys tune in next week for our next release. Take care, like and subscribe, and Godspeed.
Whether you're just getting started as an investor or you're managing a multi-million-dollar portfolio, Northbound Wealth Management has the solution for you. It all starts with building the right financial plan. To speak with a financial planner today, visit northboundwealth.com. Don't forget to check us out on youtube.com at Northbound Wealth. And make sure to leave a rating and review on your favorite podcasting app. Thank you for listening.